So believe it or not, guys, you're about to invest around 14 times more money than I did when I first got started investing with my long-term method. Because in reality, when I first started, I did not start with $100. I started out just with about $7, and that was basically it. And today, I have somewhere about a little over $280,000, a lot more, but the market is down, and that's normal. That's a part of this roller coaster, and that's fine. So you shouldn't get scared when the market goes down. However, though, one big misconception that I basically had was I thought that the way you invest $7 or $100 is going to be a lot more different than $100,000 or $20,000 or $300,000, even $1 million, okay? But in reality, the more money I invested, the more simple my strategy actually got. The less complex it actually became. I started out with 7 investments, then it went down to 5, and now it's basically just one investment. I put my money literally just into one investment. And in this video, I'm going to tell you everything. Exactly, for example, what brokerage to actually invest your money with, what to put your money into, diversification, and on top of that, what exactly should you be investing your money into if you want to know exactly how I invest my money. Now, the very first thing that everyone thinks about is basically, Tommy, with what company should I invest my money with? AKA, what brokerage? AKA, what app should I basically use? Is it Acorns, M1 Finance? Is it Wealthfront? Is it this one or that one or this one or this one, Robinhood, okay? The answer is, it's the least most important question when it comes to investing. And let me explain why. Because when you go to a grocery store to buy groceries and you're worried about your health, it doesn't really matter where you go. What mostly matters is basically what you're actually buying as far as health goes. But obviously, if you go to a mom and pop shop, you might get better service, but it's going to be more expensive. If you go to Whole Foods, it's a lot bigger, more options, but again, more expensive because everything is kind of like fancy and branded. But if you go, for example, to Walmart, big store, or Costco, and it's kind of like, it says organic, it's organic, but it's not that fancy, you're gonna pay a lot less. So overall, when you're picking a brokerage, the main things to worry about is basically, do I trust this brokerage? And how do you trust them? Not because you like them, okay? Not because you're a commercial or you saw an ad. Nah, you trust them because you know how long they've been around for. How do you figure that out? You see how long the company has been around for. There's a track record. This company, for example, like Vanguard, Fidelity, Schwab's, companies that have been around, for example, more than 30, 40, 50 years. Meaning, hey, they've been around this long, they're probably trustworthy. They have great customer service. You read the reviews, they're big enough. They manage a bunch of assets. Me personally, I no longer have the same amount of confidence when it comes into all of these little apps because overall they might offer you something brand new, some little feature here and there, but the more simple your investment method basically is, the least of these features that you actually need, or the less of these features you actually need. My English is terrible, by the way, but that's the idea, okay? So it's not really such a big deal. And when you're talking about, for example, 20 years of investing, 30 years, 50 years, I don't really want to take that risk with an app that just came out like 5 years ago and put all of my savings into it, and next thing you know, it goes belly up, and although it's covered with insurance, well, now I have to wait until that comes through, okay? I'd rather just put my money with one of the big fish that's low cost, been around for a very long time, very trustworthy, and massive, and has a very good track record, and also excellent customer service. If you ask me, I would ignore the apps, I would ignore the ads, and I would just basically go with the big fish companies, for example, like Fidelity, Vanguard, or Schwab's. Me personally, I like most Vanguard because my investment is just with one Vanguard ETF. I'll tell you more about that later in the video. Now, number 2, guys, is when it comes to this word that you're gonna hear a lot, is basically diversification. And by the way, I do want to clarify one thing. To pay somebody $1 or $10 a month, or like a small transaction fee, you might think that is basically worth it, but once you understand investing, you don't need to pay anybody anything. And even if you just get charged 1%, when you think about it, if you make, for example, like 8% on your money, you pay 2% for taxes, 1% on fees, you pay, for example, 3% on inflation, you're left with like 2%, okay? So like that 1% is more like a third of your investments. You see what I'm saying here? So it makes no sense to pay money to somebody else to do something you don't need to have them done, because it's very expensive when you talk about investing, because you're investing for a very long time. So the lower the fees, the better. My best fees that I find, for example, in Vanguard are less than 0%. I'm talking about like 0.1%, 0 something percent. That's what I care about, because I don't want to pay anybody money for something that I don't have to. So forget about paying for a little app that gives you a little feature, that has a little cool interface. I don't care if it's pretty or not. I care if it makes me money. Now, number 2, guys, is this. You're going to hear diversification a lot. And you're going to hear always the same example. Tommy, you don't want to put all your eggs in one basket, because if one basket breaks, then you lose everything you have, okay? And the answer is, yeah, the concept is sound. It kind of makes sense. But what they don't tell you is that there's a cost to put in all of your eggs in so many baskets, especially when you just have, for example, 7 eggs, and you're like, I'm gonna get 7 baskets. This is super protected. Well, when you do that, the idea is, okay, you're gonna make less money. And on top of that, when the market goes down, yeah, although I have one basket and I will feel it a lot more, well, you won't feel it that much, but when the market goes up, I'm gonna also make a lot more money, because I'm not paying rent on all these baskets to actually have it. And what they don't tell you in this example is that basically the farmer is going to make sure if your basket cracks, well, just be a little patient. And the farmer is gonna go ahead and replace those eggs and basically put everything back to normal. Let me explain what I mean by this before you're like, Tommy, I lost all my money. The farmer's not coming back. The answer is, okay, if you're investing your money, let's say into an ETF, okay? Let's say you're doing, for example, the US. And let's say right now the US market is down. But we know over the past 70 years, the US has been doing great. The US is gonna keep growing, and I have a lot of faith in the US. That's why my money is in the US, okay? So overall, I assume that, hey, yeah, the US market is down, that basket is down, but then you have, for example, the international basket, the real estate basket, the bond basket, where there's corporate or the treasury ones. The answer is all these baskets, if I had all my investments spread out, I wouldn't feel that much like the pain, but overall, I'm not gonna make that much money. But overall, the idea shows me that history shows, hey, the US market is going to recover over the long run. So I have no reason to spread my money around if I'm gonna be investing it for the next 10, 20, 30 years. That's the idea. So diversification works great for people. By the way, the best strategy is the one that keeps you in the game. So for me personally, because I know what I'm doing with investment, I'm fine with just one investment, because I know no matter what, I'm not gonna sell it, because I comprehend this very simple idea. When you have an economy, a global economy that's so intertwined, what that basically means is if we fall, the US, everybody falls, okay? It's kind of how it works, because we have a bunch of leverage on everybody else. We borrowed money from them. So if our currency collapses, if our bonds collapse, if our credit collapses, if our market collapse, a lot of other countries are going to collapse. It's going to basically cripple the entire market. And at that point, nothing really matters. So putting your money across all these other markets is just like repetition, unnecessary. It's also a waste of money if you ask me. However, people will try to sell you anything to justify charging you money. Now, that's the idea, and that's why I really don't diversify as much as they recommend you to. Now, here's the actual strategy. Here's what I invest into, how much money I invest, and what I recommend you actually do. First things first, $100 is a great start, but I don't recommend doing $100. I recommend setting up, for example, a certain percentage of your income. For example, okay, I only recommend you invest money once you're debt-free, and also once you have a fully funded emergency account. One of the worst mistakes is you trying to invest for the long term, making 10% of your investments or 12%, and then you're paying somebody 18% or 24% on a credit card or a loan or whatever. The answer is, it's dumb. Don't do that, because you're not moving anywhere. It's costing you more money. And another thing is basically, if you have no emergency fund and then you're investing money and then you get into a car crash and then you need the money from your investment account, you take it out. The answer is you're being counterintuitive and you're not actually allowing the money to grow, and it makes no sense, okay? So the best thing you can do is be a little patient. Pay off your debts first. Save for emergencies, so when you get started investing, you're actually able to do it with a calm head and not worried about, I'm going to take money out or I need to pause my investments. You don't need to worry about that, okay? Now, here's my only investment. I invest absolutely about 100% of my money, until I actually switch over my retirement account because I have to do that now. But 100% of all my money is invested into the S&P 500. Okay, that's it. The S&P 500. Tell me why? Because the S&P 500 are the 500 largest companies in the US. Imagine, for example, you look at the whole world. It's more about like the largest fish are in the US. And the idea is those 500 companies account for 80% of the entire US output as far as the stock market. So that's why I don't need to have, for example, the total stock market. And on top of that, again, as long as I don't get off the ride when things get kind of bumpy or whatever, I'm going to be just fine. And you only have to believe one thing, that the US is going to be better tomorrow than it is today. And to believe that, it's not about politics, it's not about economics or it's not about any of that stuff, okay? It's about, over the past 200 years, we've had different presidents, we've had different politicians or whatever, okay? But overall, the economy has done great because the economy is just set up in a way where we do a lot of great work in the United States, okay? And that's why I love the US, okay? That's the idea. So if you believe that America's gonna do better tomorrow than it's doing today, the answer is pretty fair. It's pretty awesome. But not just like blinkful patriotism, but it's also, for example, just like logic, okay? If we do terrible, if we end up sucking, okay, and then China, we owe them a bunch of money, and we don't ask for the services anymore. Like, the whole economy kind of cripples in a way because the economy, again, is so intertwined. So if our currency goes to trash, America goes to trash, well, everything goes to trash. And at that point, nothing really matters, okay? It kind of sounds like I'm depressed or whatever, but it's not that. But it's more like I don't have to invest in all of these things if things go bad, everything messes up. So just this one thing is fine enough, okay? So all the money is put into the S&P 500. Now, when do you change the strategy? The idea is the closer I get to retirement, let's say, for example, I'm like 65 years old and I need some cash, I might consider getting bonds, but I also probably won't because I understand that even if I take money out of my portfolio and I allow it to grow, I'll be just fine, okay? There's been math on this over and over again where you say if I make 11% here, I take out 4%, then in reality, I won't run out of money for the next like 33 years, okay? So you're pretty solid, you're pretty good, okay? That's the idea. Now, obviously, that's the first thing, what I invest into. Second thing is, how much do I invest? The answer is simple. You do between 10 to 20%. I recommend 10% when you don't own a home because your priority should be to save up money, to buy a home, to pay it off, and follow the 33% rule on a 15-year mortgage. Look it up on YouTube. I have a video on it. But the idea is you own your home in less than 10 years. That's awesome. And if you have a paid off home, then you can do, for example, 15% or 20%. And that's also pretty good. And you just basically set that. And you do it automatically. So if you do Vanguard, you set it, for example, hey, automatically pull this money from my checking account so that way I don't have to think about it. Now, third is you do dollar cost average. Now, dollar cost average basically means you invest the same amount of money, kind of like almost like religiously. So every month when you get paid, every week when you get paid, or bi-weekly, you send that exact same 10%. What happens is if you're buying when the market is high, when the market is low, over the next 20, 30, 40 years, decades, you get the average. So that way you're not focused on, I gotta buy now, or I gotta sell now. You just buy all the time, you get the average, and that way you gotta think less about things, okay? The more you learn about investing, and by the way, a great book to read is called The Little Book About Common Sense Investing by John C. Bogle. But the idea is the more you learn about investing, the more simple you're going to see it actually is. Sometimes it's just as simple as sending over 10% of your money to the S&P 500, just waiting and allowing that money to do its thing. It's really that simple. So the way you invest $7 or $100 or $1 million, it's pretty much the same, okay? At least in my book. But guys, comment down below if you made it all the way to the end of the video, and comment down below, invest, so I know you made it all the way to the end. As always, guys, like, subscribe, hit the bell so you get notified. If you have questions, the answer is comment down below. And by the way, currently right now, the app I am using until I transfer the money over to Vanguard is M1 Finance. I do like them, but they're restricted, for example, in different states. And so, well, not states, they're open in America, But for example, I live in Puerto Rico now, and they don't really have that Puerto Rico address option. And I'm like, oh, I live here, and I don't get what you're trying to do there. So I want to switch over to Vanguard. Just have one company overall, because again, these apps, they have restrictions, they have like little rules or whatever. Going with the big company usually just saves you a bunch of time in the future if you need some flexibility overall. Now, by the way, you don't have to sell when you're moving your investments. You can just basically just request a transfer, and they basically transfers assets from that place to the next place, and you don't have to worry about taxes, okay? That's awesome too, okay? As always, guys, like, subscribe, hit the bell so you're notified. Comment any questions. Up here is another video. Over here's my faithful subscribe. And as always, long-term team officially out.